Welcome back to Make It Personal, the show where we talk about real money and real life. Every so often we take your questions and we turn them into practical conversations that help you make better financial decisions. And today's question is a great one because the answer recently changed and not everyone realizes it yet. Today's question comes from Jennifer. She asked, if you make contributions to a Roth 401k, how do the employer contributions work? Are those contributions and their withdrawals also treated as tax-free? Jennifer, excellent question. And until recently, the answer was simple, and it was no. Employer matching contributions always went into the traditional or the pre-tax side of your 401k, even if your contributions were Roth. But that changed with the Secure 2.0 Act of 2022. Under the new rules, employers are allowed to let employees treat employer matching contributions as Roth contributions. And that word allowed is important. This is not automatic. Your employer has to specifically offer it in the plan, and many plans still do not. Here's how it works. If your plan does allow Roth employer matching and you elect it, the match is taxed in the year that it's contributed, just like your own Roth 401k contributions. And then it can grow and potentially be withdrawn tax-free in retirement. If your plan doesn't offer Roth matching, your employer match goes into the traditional 401k, you get the tax deferral or the tax break today, but those dollars and the growth will be taxed when you withdraw them later on down the line. And this matters more than most people realize. Over a career, employer match dollars can make up a huge portion of your retirement savings. So the question of when those dollars get taxed, now or later, can have a real impact on your long-term plan. This isn't just about today's tax bracket. It's about your future income. It's about required minimum distributions or RMDs. It's about Medicare premiums, and ultimately how much control, flexibility, and options you'll have in retirement. So what if your plan doesn't offer Roth employer matching? Here's the good news. This is where an advisor can help you explore other ways to build tax-advantaged income. Depending on your situation, alternatives may include funding a Roth IRA if you're eligible, using a backdoor Roth strategy, or for some people, using properly designed cash value life insurance as a supplemental tax-advantaged savings tool. The right mix depends on your goals, your tax picture, and the kind of retirement flexibility you want. Because retirement planning isn't just about checking boxes in your 401k. It's about understanding your options and having a strategy when the plan rules don't give you every tool that you want. Jennifer, thank you again for the great question. If you have a question you'd like us to answer on the show, comment on the platform you're watching or listening to, or email us at makeitpersonal@mutualofomaha.com. And if you'd like help in reviewing your employer plan or building tax-efficient alternatives, let's connect you with the Mutual of Omaha advisor. We're here to help you design a plan that supports the life you want to live, not just the one you think you're supposed to. Because it's your money, it's your plan, it's your future. Until next time, make it personal.
This podcast is for educational purposes only and may include references to concepts that have legal and/or tax implications. Mutual of Omaha Investor Services, Inc. does not provide tax or legal advice. Please consult with the appropriate professional regarding your personal situation prior to making any financial decisions. Strategies discussed may not be suitable for everyone. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Mutual of Omaha Advisors is a division of Mutual of Omaha Insurance Company.